Good evening and welcome to the 9th edition of our Quarterly Connect webinar. Thank you for taking time to attend this evening. As always, we thank all our investors for entrusting us to manage your wealth and all our distribution partners for the support extended to us over the last many years. Our agenda for this session of the Quarterly Connect webinar is threefold. Prashant will start off and provide an update on the portfolio and the performance. This will be followed by our views on the budget and key takeaways. The third part is a very interesting angle. We will spend some time talking about the opportunities in the global emerging markets. As some of you might be aware, recently we've launched our Global Emerging Markets Fund X India strategy, which provides investors an opportunity to invest across emerging markets. We'll have a Q&A session at the end. I'll request all of you to kindly post your questions in the chat box. I now invite Prashant, the founder, to start with the portfolio update. Over to you, Prashant.
Thank you, Vivek, and thank you all for joining today evening. I see people are still joining, so some of them would join midway. Hopefully, they won't lose much. I'm going to try and run through a variety of things, that Vivek mentioned within half an hour so that we have ample time for Q&A. I'm going to skip, in the interest of time, the regular update on the firm and all. I'm going to come straight into performance, which was quite challenging, as you all would be aware, last year, underperforming by 1100 basis points. Since inception, or 3-year, 5-year numbers still remain strong, as we'll see later. Since inception, performance continues to be driven by stock selection. So over the 3-year time period, portfolio performance been 93 compared to 69, 24%. This is gross alpha. For 34% stock selection alpha, there's been a minus 10% allocation effect. Now, stock selections always considered more skill-based and hence more valuable. Allocation effect over long period of time is a zero-sum game. Here too, on a sector attribution, previous slide was market cap attribution. This one is sector attribution. You again see more than 100% of the alpha comes from stock selection. Some of the top contributors and detractors, usually this is a investor's favorite slide. So this is over the last coming up to 4 years now. You'll see some of the top performers over a 4-year period has been from the IT sector. So Coforge contributing 500 basis points, LTI Mindtree contributing 300 basis points, Dixon, not quite technology, but one of the new age companies contributing healthily. I highlight this because these guys had a particularly tough years, as you'll see shortly, last year, despite and after including the poor performance of last year, these stocks have done very well. However, I would point out that there are various sectors like pharma, like finance, which have contributed to the strong performance. Obviously, the detractors are there as well, but detractors are much smaller than the contributors, which is good to see. And both detractors and contributors are very well diversified. All stuff that you have, you're all familiar with. This is just last year. Last year performance was weak both on stock selection as well as on allocation effect when viewed from a sector attribution or viewed from a market cap. So initial slide was market cap attribution. This one is sector attribution. The sector allocation effect was more negative than the market cap allocation effect. I have noticed over my past 16 years of professionally managing India portfolios, the time periods when the allocation effect is negative, the short time periods when allocation effect is sharply negative, tend to also have weaker stock selection effect. And this was the case last year as well. These are the top contributors and detractors last year. You'll see that amongst the detractors, Coforge, Emphasis, Persistent, and if you were to include Dixon, or at least these three are from IT services, as NASDAQ, as you all know, was down 30% or thereabouts last year, and IT sector in India did very poorly as well. We had a fairly good allocation or sizable allocation, let me put it that way, if not good, fairly sizable allocation in mid-cap IT at the start of the year and through the year, which did hurt us considerably, as you can see here. Though over the last 4-year, 5-year time period, these stocks have done extremely well for us. Now, a lot of performance discussion we've had over the last 3 to 6 months. So I don't want it to be very repetitive for everyone, but I do want to do proper justice and cover it very briefly and quickly. And if you want deeper discussion, maybe in Q&A we can go through that, while I'll try not to be repetitive, because those who attended the prior calls might find it very repetitive. What this is, an update of performance compared to the top dozen or so, you may call it, or at least top 10 other portfolios in the PMS competitive or peer group, if you will. So as the graph table here shows, these are all funds that are above, schemes that are above 2,000 crores, as written here at the bottom. Now these, since they are the largest schemes, there is a certain positive selection bias in these, as they've grown large because they've had strong performance over the last 3-5 years or longer. You will see that WhiteOak strategy over a 5-year period is the best performing of the top PMS schemes. And each of the years, so blue represents above average. The darker the blue, the more above the average it is. Red represents below average. And the darker the red, more below average. So we have been in blue every year, though there are different shades of blue, but including last year, we were in the lightest of blue shades, but were blue nonetheless. As you'll see in the next slide, this slide shows how we have ranked amongst the top peer group since our inception, calendar year wise, and then on a 3-year and a 5-year or since inception basis. So you'll see we've consistently ranked in the top half. In 2017, 2018, we were the second best. 2019, we were fourth. 20, we were the best performing. 21, again fourth. 22 is the worst showing in the last 5.5 years, but still we are, if you were this being the benchmark, it is not a fund, we were 5th out of 11 managers compared here, which are all chosen as the ones above 2,000 crores in AUM. So we are over a 3-year period, 4th in rank, and since inception remain the best performing strategy. And we are the only one over this time period who in each of the, and it's not going to always stay that way, and it's not necessarily, it's just a matter of fact. It's not something that one can claim to be able to do always, but at least over the last 5+ years we've always been above average. Otherwise, if you see the second best performing, which is the portfolio 1 year, over the last 5 years or so, they have been at the bottom of or near the bottom of the pack in years 2018 and 19. Portfolio number 2 over here has again been towards the bottom in 2017 and below average in 2021. Similarly, portfolio number 3 was at the bottom in 2022, last year, and also closer to the bottom in 2018. Similarly, portfolio, and as you go down lower, obviously the frequency of those portfolios to be like portfolio 8 has been in the bottom in 2022, 2020, and below average in 2019, and so on and so forth. Portfolio number 9, bottom year in 2018 and 19. So obviously a lot of you would be very curious to know what these portfolio names are beyond just the numbers, but just from a proprietary perspective, we can't give the individual names, though these are all public data, PMS Bazaar data that we have. use. So the bottom line is performance, while last year was challenging, it was challenging for most managers. As you can see, S&P BSE 500 was the second best performer. Only one manager last year outperformed in this list of dozen odd man or 10, 11 managers, and most managers have underperformed. It is disappointing to us, no doubt, but it is not a realistic expectation for even us to have to be at the top of the peer group every individual year. Over the long time period, we definitely aspire to and work towards and have historically achieved peer group beating performance. Now, what is long term? There's no simple answer. I've been asked this question forever. Is 3-year a long term, 5-year a long term? Not necessary. There could be 5-year plus time periods which aren't long term, and there could be 3-year periods which are long term. It all depends on how the market has behaved during those time periods. And last 3 years certainly have not been long term. I've always told clients one must measure performance during from like point to like point in a cycle, and that may or may not occur within 3 years. And I'll share later in the presentation why last 3 years aren't like point to like point. This is just another way. This slide is just another way of presenting the previous slide, where we are, here in this row, and it shows just in different years how many managers were performing better than us and how many managers perform worse than us in the top 10 comparison set that we're talking about. Now, so this is on peer group performance. This, I think we've shown last time. Last year was a very interesting year. It was my career's worst year, and yet we received maximum awards that I've received in any given year, because all these awards are for 3 years, 5 years time period. So I've talked about peer group performance, and I'm going to talk a little bit more on the performance. So this is what the 5 years look like in terms of alpha. These are numbers same. These are the same numbers that we saw in the prior slides as well, but just presented in a different way. This year obviously is a sizable negative gross. These are gross of fees basis. Annualized alpha of 6%. Rolling 3-year alpha still is positive, as you can see, and has been very strong positive earlier at 30%, 40%, and now has come down a lot because of the negative year and having dropped the positive year. Now, there are some comparisons we've made, even though one could argue these are not fair comparisons, as we cannot dare to compare ourselves with some of these great people from various fields that we are comparing against. But this is to just show that even revered people, I think there are more followers and fans and bucks of Warren Buffett in India than I saw in US when I managed money there. And a lot of people from India make the trip to Omaha every year. But I don't know how many people realize that over the last 16 or 15 years, 16 years actually, I've chosen this period, 2007 to 22, because this is a time period which overlaps with my professional money managing experience. And it's also a nice time period to have because it includes global financial crisis. Yeah, it's always important to see how managers perform during good times, but also very importantly, during very bad times. You must, if a manager has managed money during 2008, you must ask how was the performance during that time, because sooner or later a crisis would hit, just like the COVID crisis hit. So fortunately, I've had the opportunity to be managing through crisis. And so I've just taken, for some such comparisons, people from different walks and the performance over this time. So you'll see Warren Buffett has over this time period generated 9.5% return compared to S&P 500 of 8.5% for a 1% alpha. Now, this came as a shock to me and possibly to a lot of you, because you usually associate Warren Buffett with very large outperformance. And it's been only 1% annualized over the last 16 years. Albeit, I must say, it is against the US market. US market is very difficult to generate alpha against. And this 1% alpha over the last 16, 17 years would probably put him in the top decile or top quintile. But still, it is not what one would expect as a very large alpha and top ranking alpha, if you will. And important point though is it's not come in a straight line. There have been years of massive underperformance, like minus 24% in 2009, minus 21% in 2019, and so on. If you look at beginning of 22, it was actually underperforming for the previous 15 years. So if you had looked from 2007 to 2021, it was underperformance over a 15-year period. Yeah. Whereas, you all expect Indian managers to outperform every year. But someone like Warren Buffett, whom you all consider God of investment, he underperformed for a 15-year period from 2007 to 2022. And his rolling 3-year, if you were to take this dark line here, is the rolling 3-year number. So at the end of 21, his rolling 3-year number was more than minus 50% negative alpha, because he had minus 21 and minus 16 out here. So just wanted to show that there are other fund managers around the world who are far more accomplished and revered, who've had some very challenging time periods. Historically, they have not delivered performance necessarily in a smooth line. Over a much longer period, they've suffered underperformance. Here's another very interesting example, very close, much closer to home, something you're all very familiar with and experienced in your investing time, a lifetime. This is HDFC Bank versus the Nifty PSU Bank Index. It's a self-descriptive, don't have to explain that further. Now, annualized return over the last same 16-year period, HDFC Bank has delivered 15.9% for a 842% cumulative return, a ninefold jump or more. Whereas Nifty PSU index has given only 1.4% annualized return, a cumulative return of 33% only. HDFC Bank has outperformed by over 800%. Yeah, but it's not come every year. This outperformance, annualized outperformance of 14.5% hasn't come every year necessarily. It's, you'll see at 2007, 2008, 2009, 3 years in a row, HDFC Bank underperformed the PSUs, as you can see over here. And last 2 years, it's massively, again, underperformed. If you see this line, which is 3-year rolling period, most of the time it is above. For us, I mean, for the 16-year career, if you were to look at, I've been fortunate to have a 3-year rolling 3-year period, which so far at least has always been positive. But sooner or later, just like you see with these other examples, it's possible that that turns negative as well. And you see right now, HDFC Bank over the last 3-year period is trailing the PSU banks by almost 50% on a 3-year rolling basis. These are all cumulative numbers. Does it mean HDFC Bank is a worse bank than a PSU bank? Does it mean now investors should switch from, because last 2-3 years have been poor for HDFC Bank, should switch from HDFC Bank to PSU banks? I don't think such an inference can be drawn. Neither the opposite inference can be drawn. Just because HDFC Bank has outperformed doesn't mean you have to jump into HDFC Bank. That is a separate decision-making process. What I'm saying is, just because a year or 2 years or 3 years performance has been negative for HDFC Bank doesn't necessarily mean that it has lost its way, or because it has underperformed in the past as well, and over time remains one of the best performing bank. Here's third example. So we took an example of Warren Buffett, then HDFC Bank, and now a different field altogether. Tendulkar, probably a favorite batsman for everyone. What we've done here is compared his batting record with top 11 batsmen of India, contemporary batsmen, so who played during similar time frame or overlap with Tendulkar. And is the averages, each year's average of Tendulkar. So he averaged over time 53 runs. The 11 top averaged at 45. So you can call it, he had an 8-run alpha over the other top performing batsmen. And many years he had very strong alpha, much higher than the 8-run alpha. Yeah, because here his average was nearly 90. Here it was 85. Here it was 85 to 90. But there were several years where he was well below average. Here nearly 25-run average compared to 45 of the peers. again, similar. And he had probably a stretch of 4-year period, midlife crisis of sorts, where his average was possibly below that of the peers. So I can give many more such examples, but the point is that as much as we would love to have year after year positive alpha, quarter after quarter positive alpha, beating everyone else out there, we understand, we have high expectations of ourselves, and we understand you have as well. But I'm just saying that in all walks of life, it has been unrealistic to expect that out of even the best of the performers in each walk of life. And we are similarly susceptible to the same phenomenon as well, that periodically there would be times of underperformance, as we saw last year. And while last year was a full year of negative, and I showed earlier that all the other years are positive, but intra-year, there have been negatives, as I've shared before as well. As you can see, in a 3-month period or more, a little over 3-month period, we underperformed by 7%. In a 40-day period year, we underperformed by 5%. Yeah? Yet those years we closed, full year was positive because the rest of the year was so strong that we closed positive, and subsequent 12 months delivered very solid alpha as well. This year, underperformance started pretty much from the end of the prior year and persisted through the year. Now, I must see this, so running short on time, so I'm going to skip what I have discussed before on the causes of underperformance, but I'll just quickly say that portfolio construction is an important element. What it means is allocating more capital, or basically portfolio construction is optimization between two competing objectives: maximizing long-term alpha, minimizing short-term volatility of alpha. We achieve that by allocating more capital to alpha-rich segments of the market and allocating less capital to alpha-poor segments of the market. Everyone can agree, possibly there is less alpha in large caps, there is more alpha in mid and small caps. So we allocate more of the portfolio here in terms of relative to the benchmark. So benchmark is about 20% in mid and small. We have about 40% in mid and small. Over time, that has helped generate higher alpha than the benchmark. But in time periods when mid and small do poorly, like last year, that can act as a headwind to our alpha generation. Similarly, we believe, for various reasons we've discussed in the past, not to go into details, but segments of the market which have poor governance have less alpha potential compared to segments of the market that have good governance. Now, over the last year or so, this segment of the market, or last 2.5 years, I must say, or March 20 onwards, nearly over the last 3 years, the segment of the market or segments of the market which we consider to be less than ideally governed has expanded from 10 to 15% to something like 20 to 30%, because those segments of the market have done very well. And that has acted as a big headwind to our performance. So these two are major risks that we tolerate to generate higher alpha over time, which is we have more of mid and small cap, and we have more of better governed companies. And as a result, there are certain sectors that are always underweight in the portfolio, like energy, utilities. Even right now, we have 0 weights. PSUs, while there isn't a separate sector, but across sectors, we hardly own any PSUs. So when such sectors do very well, such segments of the market do very well, that would be a headwind to us in the short term. And that was the case last year as well, which I'll just share as well. Now, over the last 12 months, we have added more to industrials. I must just, while I'm on this slide, I can add, and you might have seen some of the people, that number of names, while always has been high for us, and there's reason why, which we've gone over umpteen number of times, and so interest of time, avoiding going into it now. But the names, we have added a few names in industrial segment to act as because they often act as a hedge against energy and utilities. And there are some well-governed names in industrials that we have added to the portfolio in recent quarters. And then that has worked well as a hedge, as despite energy utilities continuing to, and the less well-governed segments continuing to do well over the last 6 to 8 months, performance has held up better than say the first half of last year. Mid cap, small cap, as I was saying, continue to be 38% in the portfolio. So this is what we have discussed several times. As you can see, over the last 12 months, it was the worst time period for relative performance of well-governed overweight segments in our portfolio compared to the, according to us, poorly governed underweight sectors in the portfolio. And similarly, it was a tough time for mid caps compared to large cap. And these two together, if you were to just mathematically add them, is 27%, minus 20% headwind, if you will, which is worst compared to the sum total of the other time periods. And hence we've had tougher performance this time than at any other point in the past. However, I must add, over the last 5 years, despite having a headwind of, so what this red line is basically relative performance of our overweight segments, which are better governed compared to underweight segments, which are worse governed. We've had a 25% headwind, and yet we have generated strong alpha, which, as we discussed, is best compared to the at the top of the peer group, or top end of the peer group, right? Despite this headwind. However, if you see over the last 3 years, from March 2020 to now, there has been a one-way decline in well-governed companies compared to poorly governed companies, or poorly governed companies have massively outperformed over this time. And hence, this 3-year time period is not a long enough time period to measure performance. 5-year also has been a headwind, because ideally you should perform over on this graphic like point to like point. So whenever this point crosses again 100, you should compare from there to here. So you've seen a cycle of good performance doing well, bad performance, or good governance doing well, bad governance doing really well, and then coming back to the normal x-axis. Yeah. Similarly, here small caps have also, small and mid caps also, over this 5.5-year period have underperformed by about 20%. Yeah, and still, so here this is index is below 80, and still the team has, despite both these doing poorly, this and this doing poorly and being a headwind to us, the team has generated more than 20% alpha at the top of the peer group, which is highly commendable. So it's an important point I want to highlight. The background in which the performance has been generated has not been a conducive background for us over the 5 years as well, but particularly over this 3-year time period has been most challenging, given the way we manage money, where we allocate more capital to better governed companies and more capital to mid and small. In the interest of time, I'm going to jump. Everyone knows about the budget, so I'm not going to spend much time. It was a good budget, but obviously there are other macro considerations that were floating around, and hence nobody paid much attention to the budget. I'm going to jump and now spend some time on EM. I understand several of you are already investors in the EMX India Fund. So thank you all for being the early investors here. And several others are in the process, I believe, of the paperwork and all. This is probably one of its kind that we've launched, because most people launch EM fund. What we have is, what we have is EMX India Fund. And the reason X India is not because we don't like India, we love India, but Indian investors under LRS cannot, or there is some confusion on whether they can invest in EM fund, which invests in India as well. So we have, but keeping particularly in mind people in LRS who may not be able to invest in India through the EM fund, we have launched an EMX India Fund, so that fund does not invest in India. We already have something which is a general EM fund, including India, which we launched in June of last year. So we'll share some performance of that as well. So what is the EM funds performance? So the one that we launched in June, because the EMX India we just launched in December, so only a month's performance. In future quarterly connects will share that as well. But in the EM fund, as you can see, the team started off with very strong performance over the last 7 months, generating nearly 10% dollar return compared to 2% of the benchmark for 800 basis points of alpha. When markets tanked into third quarter, team generated good alpha as it went down well. And when markets bounced back in fourth quarter in January, team more than held up. And this is the INR performance because rupee has depreciated. So INR return over the 7 months has been 13.72. Again, alpha obviously would be similar as in dollar terms. During this time, BSE 500 for what it's worth is up 11-12%, as Indian markets have done well during this time relative to EM. It's just the last 2-3 months that Indian markets have underperformed actually by 26%. So between June to October, Indian markets outperformed by 25-35% or something. But from October till January end, I believe Indian market underperformed EM by some 25% or so. So all of the consistent with our India strategy, all of the performance of EM strategy out of 8.4, 8.3 has come from stock selection, positive across market cap segment. Similarly, when you look at the country attribution, country-wise attribution, again, out of 8.4, 7% of the alpha has come from stock selection, positive across almost every country. It is very good to see, as stock selection suggests skill rather than luck. Similarly, on industry attribution, 7.4 out of 8.4 again comes from stock selection, positive across almost every industry, the stock selection. Finally, some top 10 names, contributors and detractors. So you'll see Hermes, LVMH. So we do invest in some developed market names which derive predominance of their value from emerging markets. So Hermes and LVMH, a lot of you would be familiar probably with these names, as your family members or yourselves might be carrying their very popular bags or other accessories. And more than half of the value, I mean, nearly 3/4 of the value of these companies in our assessment come from emerging markets. And nearly 50% of the value comes from China itself. So rather than investing in China directly with all the associated issues from time to time, it's better to invest or get exposure to China through these two French companies, Hermes and LVMH, as the Chinese consumers are big fans of their products. So if I were to go to just quickly, EM can be, or EMX India can be a very good diversifier for investors who have very high exposure to India. Over time, 20 plus years, they're more or less similar dollar returns. But from year to year, there can be huge differences. So as you can see, in 21 and 22 calendar year, EM substantially underperformed India by 33% and 16%. But year to date in January, it outperformed by 13%. And the prior 2 years, it had outperformed by cumulative 12%, underperformed, outperformed, so on and so forth. So rather than, so as none of you have 100%, I assume, unlike me, or probably only few people have 100% in equities. So for diversification, you invest in equities and debt. I would say do evaluate investing in other equity markets, be it EM or developed, instead of debt, as they can provide diversification just as debt provides, but at the same time provide higher returns, which debt does not provide, especially real returns, as debt has not been able to keep up with inflation after tax. The valuation for EMX India looks fairly attractive at this time. At least the discount is at one of its widest. So what this slide is here is the average, on average 20 years, EMX India is traded at a 28% discount to Indian multiple. Right now, it is at 51% discount. Yeah, so it is like a 2 standard deviation or more, because 1 standard deviation is about 35% or so here. It is more than 2 standard deviation discount compared to the longer term averages. And similarly here, you can see a discount to the world, not just to India, but a world which is predominantly developed world, is at 35% compared to the 20-year average of 27%. So at least it is towards the lower end of the historical valuation range. That's something that one can say from these numbers. MSCI EM's valuation relative to its own self, if you see, is close to, it's trading at just under 12 times PE, which is similar to its long-term average. And on price to book, it's trading at about 1.35 times, which is somewhat lower than the 1.5 times multiple that it's traded on average. Obviously, these multiples are much lower, about half as much as that of India, which is what is evident from this 51%. That is what is meant by this 51% discount, that the multiple is half as much for what it's worth. This graph shows where are the various EM markets. Turkey towards, obviously there are a lot of problems with Turkey, but it's at its lower end. Hungary and most of the countries you'll see are towards the lower end of their historical multiple range. India is towards the upper end or in the upper quartile, and there are a few other markets like Kuwait, Thailand, which are there in the upper end, but otherwise most markets are towards the lower end, or whether you look at it on price to book or on PE multiples. EM's performance over the last 30 years relative to developed world shows that right now it is close to the all-time bottom in terms of performance relative to developed world. This is what our portfolio, EM ex India portfolio, looks like from a sectoral weight perspective. Similar to India, where we don't own any energy or utilities. We don't own energy utilities here as well, pretty much for similar reasons, because they tend to be owned by governments like Petrobras, PetroChina, whatnot, or otherwise there are some governance challenges. We have considerable investments in consumer discretionary, IT, and so on and so forth. From a regional weight perspective, we're pretty balanced, 75% in Asia, ex-India, and we have a 27% investment in developed world. So on a basis, country of domicile, Asia is only 56% and developed world is 27%. But when you adjust for the economic value, where is it being derived from, you see that 75% of it comes from Asia, as LVMH and Hermes and all, as I mentioned, they have substantial exposure to Asia. These are some of the top names in the portfolio. Several of these names, I assume, would be familiar because they're household names globally, not just in their respective countries. TSMC, $500 billion market cap. It is the source of the geopolitical tension between China and US. Just like Middle East, always people believe the reason US is interested, or the reason Middle East is source of geopolitical tension is because of the oil reserves. Similarly, Taiwan is in the midst of the storm because of TSMC's capabilities. They are, without doubt, the leader in leading edge semiconductor and chip manufacturing. Samsung is the Korean giant that we all are familiar with, along with TSMC. You know, every phone that you use, be it Android or Apple or anything, every phone has both TSMC and Samsung components of fairly considerable degree in them. We talked about LVMH and Hermes, the fashion goods companies. These are also amongst the top names in the portfolio. So there are a lot of great business franchises around the world, which are very different from India, which you can get exposure to through investment in a EM fund like ours. We talked about, you know, and these are in technology. Like India has a lot of IT services companies, but nothing in technology, hardware, whereas Taiwan and Korea, TSMC, Samsung are the leaders in very complementary parts of technology. Hermes, Louis Vuitton, we already talked about, so I'll skip these individual names. ASML is again a Dutch company, which is center of, you know, not controversy, but attention, because it produces the equipment which allows companies like TSMC and Samsung to produce the very high-end chip. And American government is has worked closely with Dutch government to ensure that ASML does not sell the technology to China. So that's the nature of the technology, that it's considered so crucial in terms of the chip supply chain and food chain, if you will. So I'm just going to stop here as I'm mindful of time. We have taken up 45 minutes nearly. I'll just take a minute here to say the portfolio composition. As you can see in the portfolio, while in the benchmark, 75% in Asia, in the strategy, 56% is directly. So it seems minus 19%. But if you include weights like LVMH and all, it will be 75%. Similarly, in China, the benchmark has 38%. Direct investment is only 26 for us. So it seems like minus 13%. But then including companies like LV and Hermes, we have adequate exposure to the Chinese. So we have exposure to the Chinese consumer, which is desirable. But at the same time, we have less exposure to the Chinese regulations or Chinese government, if you will. Overall, we are more exposed to democratic countries. So in MSCI XEM, 50% is roughly democratic countries, 50 are authoritarian countries. In our portfolio, it's 74 and 25, with hardly any exposure to Middle East and so on. And same as in India, while in the benchmark, 20% of the market is in SOEs or government-owned companies. In our portfolio, that exposure is only 1%. So I'll pause here, as these are all macro slides related to India that we are all familiar with. Otherwise, I'm happy to walk through if there are any questions. But at this point, we'll like to open it up to questions, and hopefully there are quite a few. Vivek, back to you.
Thanks a lot, Prashant. I'll request everybody to type in their questions in the chat box at the bottom of your screens. So Prashant, while the questions come up, there is, as we've been talking about the emerging market strategy with clients, one question we've received quite often is about China being a significant part of the emerging market basket, and with a lot of macro headwinds that there could be there. Just your thoughts on that from the investment in China.
See, obviously, over the last 20 years or plus, or always, I would say, there are always headwinds in every market from time to time and tailwinds from time to time. I've had in June 2020, so right after COVID, we've hardly seen outflows, touchwood, from India by foreign investors, at least talking about WhiteOak. But June 2020 was the highest outflow. Couple of very long-standing investors and believers in India exited because they said there are major headwinds for India. India is not going to be able to deal with COVID. It is chaos. This migrant crisis was there and whatnot. Whereas look at China, despite the virus originating there, they've got it under control. The whole world is reeling under COVID virus, whereas China had it in control. So we are moving the money from India to China. So China was the favorite investment destination mid-2020. I think safe to say amongst emerging markets or anywhere globally. And then 2 years later, it turned out to be the worst destination in people's mind. So these things come and go. 6 months ago, there were a lot of people asking us to launch GEM ex-China strategy, because China was down 50% from its peak in 21. Today, I don't think anybody's interested in, or far fewer, a fraction of those people would be interested in GEM ex-China, because China is up 40% or something from the bottom, and people are seeking China exposure, whatever reason, because it's underperformed, because now COVID zero has gone away, so it's reopening. So China normalization story. So all these stories are made after the market moves. And I don't believe that, investment decisions should be made based, or we've discussed this oftentimes, but when you make investment decisions based on what you see going on in the macro environment on the day and reading the newspaper and social media, that's not going to have much value in terms of performance generation in our view. So yes, we intelligently seek to mitigate the risk, as I shared with you. We have greater exposure to Chinese consumer through companies like LVMH and Hermes and so on. But China remains the largest EM country, um, and you cannot ignore it, in my view.
Sure, Prashant. Thanks. Actually, keeping in, talking about flows, there's a question on FIS flows, which was, as we all know, stopped or quite, there was a lot of outflows last year from emerging markets. What's the impact like of that this year? Could the markets and the portfolio go further down in absence of FI flows?
Sorry, I could not follow the question. Can you repeat that, please?
Yeah, Prashant. Basically, the question FI flows, we saw some bit of outflows last year. What would the flows be like this year? And in absence of positive FI flows, could that impact the markets?
So see, FIIs are no longer as important as they were believed. So even back when they were believed to be super important, I never believed that they're that important. And today, if you look at I'll just open up the slide here. If you look at the numbers, they themselves show that they're not that important anymore. So if you see here, last year, I'm just going to take the pen, FIIs had the very worst year, minus 17. I mean, it was the worst year of FII flows at minus 17%. Minus $17 billion. It was worse than 2008. Obviously, as a percentage of market cap, it wasn't as bad as 2008. But the inflows in India have been quite strong. It was the best year of inflows in India by absolute dollar terms. So Indian amounts have become far larger, as I think is well known now, $20-25 billion kind of range compared to FII flows. Whereas if you look at before 2014, the Indian flows were very small, whereas the FII flows before 2014 were quite dominant over here. And that has flipped now post 2014. So I think FII flows, first of all, they are impossible to predict. The only thing I can say is if markets do very well, there would be positive flows. If markets do very poorly, there could be negative flows. It's not that the FII flows determine whether the market goes up or down. It's the other way around. If markets go up, FIIs would come in. If markets go down, FIIs would exit. Just like retail investors in India, they would also scale back or might even go negative if there's a sharp downturn, as was the case with hold on, I'll just show. As was the case in 2010. 2012, 13, when markets were down, there were outflows from Indian investors as well. So back to you, Vivek.
Sure, Prashant. Thanks. I think there are a lot of questions on the emerging markets fund and how to invest and what is the minimum requirement. Maybe Prashant, I'll answer that that part of the question. Yes. So the emerging markets fund ex India is a UCITS fund which is domiciled in Dublin and is managed by WhiteOak Singapore. The best way to invest in emerging markets fund for resident individual investors is through the LRS route. The LRS route permits you to remit $250,000 each year for investments outside India. So we have an office based in Singapore who would help getting the investment through. We've also onboarded the fund in with some of the private bankers in India, and they would also be able to facilitate the investment. The minimum amount required is $25,000 for investment, and it is open to all resident Indian investors investing overseas. It's also available for investors who are based outside India and want to invest in a dollar-denominated product as part of their overall portfolio. In terms of the documentation, etc., it's relatively straightforward. You just need a identity proof and an address proof and fill out a subsequent document through which we can then make that investment. It is very similar to a mutual fund in the way it operates. It's unitized. It has daily liquidity. You can invest and exit on any day of your choice. And happy to answer specific questions separately on how to invest in the fund. So maybe Parag, there's a question for you on the Indian financial sector, and how do you see it performing in the next 1 or 2 years, and any specific risks which you might want to highlight?
No, well, see both on the financial sector as such, you can divide into two parts: lending, non-lending. I think on both the side, the banks, NBFCs are doing quite well. If you look at all the parameters of the lending companies, whether it is loan growth, whether it is margin, whether it is asset quality, I think on all three parameters, which are predominantly more important, on all these three aspects, our banks as well as the NBFCs, what we own, is doing quite fine. And I think, same trend is expected to continue. We don't see, much impact on growth. There will be some, cyclical, downturn to the margins, it happens arithmetically. But otherwise, as we head for next 1 or 2 years, I think lending financials should be very, very fine. On the non-lending side, there has been some changes on the insurance, especially life insurance from the budget. To that extent, what we think is there could be some reset in terms of business prospect for 24 and 25. But I think the opportunity for the long term for the life as well as non-life sector remains very promising. So, there also we believe that the business as well as the stock should do relatively very well. Vivek?
Sure. Thanks, Parag. And maybe Rohit, just a quick question on the consumer sector from you. Again, the opportunity next few years, any risks that you see?
Sorry, this is opportunities in the next few years, right?
Yes, Rohit.
I think Indian, the overall consumption space, when you look at consumption in India, it's not just the next few years. I think this is going to remain a growth sector for the next few decades, maybe. Right now, the key really is what categories will grow, which companies will do well. That's really where opportunities will come as a overall pack, right? If you look at private final consumption expenditure, that's about 58-60%, right, of our GDP. Right, India is a domestic consumption story in some sense, right? Now within that, there are of course various dimensions, cuts that you can look at: staples versus discretionary, urban, rural, right, SEC, class. So what consumer categories, what do they consume? How will each of those segments of the market evolve? And on a bottom-up basis, you take a call on which are the best opportunity segments and companies therein. Now, there's perhaps a burning question on everybody's mind in terms of whether we are seeing a consumption slowdown and how do we read that. Now, again, while this is a multi-decade growth story, there will always be some phases where consumption growth will slow down. It's an upward sloping curve, but with variations. You'll have a sinusoidal wave, right, where growth rates will fluctuate, right? And what we have seen in the last 1.5 years is, of course, the households have had to adjust their budgets to rising inflation, right, in their consumption items, monthly consumption basket, as also with rising interest rates. Some of your EMI commitments, etc., they go up. So overall, there is some pressure on disposable income. There are adjustments that households and individuals are making, some more than others. That is the case-shaped, recovery and impact that we've been hearing about. And that has started reflecting in some slowdown in consumption growth. But these phases are not new. These phases are going to happen, every few years. But the long-term consumption story is intact, has to be played on a bottom-up basis, looking at segments and companies.
Sure, thanks. So Prashant, back to you. So there is a question on what do you think could be 2 or 3 reasons which at all might derail the India growth story in the next 2 or 3 years, or the risks to the Indian markets?
So obviously there are a lot of known risks. Like if globally things were to collapse, then obviously India is not insulated. And this is perennially always a relevant risk. Nobody knew something like COVID were to happen. Nobody knew that Russia would be invading Ukraine, till these things. So these are unknown risks which can happen anytime. If for whatever reason inflation were to spike again, so it has been on a declining trend globally over the last 6 odd months at least. If for whatever reason, let's say worsening of the war situation, Russia, Ukraine, some bomb gets dropped somewhere and that prompts disruption or supply shock. And if there is inflation, that could have global impact as well as on India. Importantly, in India, there is a central election coming up next May in about 15 months' time. Now, everyone believes there would be a favorable outcome for the market, but in politics, you can never predict and never be 100% sure. The market has now liked continuity historically. And if that were to continue, that's well and good. But otherwise, if there are any negative developments on that front, then market may react because it would be something that is unexpected from market's perspective. Obviously, you can paint any dire situation, on a geopolitical front and whatnot, but you have to think of what is the probability of those events. So no point in, like China-India conflict. Now, what is the probability? Those things. So the probability that there is already factored in the market. We don't have any special insight where we believe certain macro event is, and nobody has these insights. People who believe they have insight don't have a clue that they don't have an insight. We just are aware that nobody has an insight on any such macro development, which the market is not anticipated with appropriate probability, and others have. There are no such things. Obviously, all these macro developments, market has already incorporated them to their probabilistic level. So there is a certain probability that inflation can spike up again. Market has already been is reflecting that probability. But what market is reflecting is the probability, not the event. So if something has 25%, let's say when you roll a dice, 1, 2, 3, 4, 5, 6, the probability of 2 coming up is 1 in 6. But if 2 comes, that becomes 100%, right? So if something like that were to happen, it is not to say that market would not go down. Market may go down, but whatever is a appropriate, reasonable probability of such a thing happening has already been factored in by the market at this time. So if inflation, so on the other hand, if inflation were to continue to go down and hence Fed stops raising interest rates and whatnot, markets may rally in the US and in India and elsewhere globally. So that's how I would pose the biggest uncertainty at this time would be from an India specific perspective, the elections in 15 months time.
Sure, Prashant, thanks. And just as a follow-up to that, there's a question, and this I know you answered many times in the past, is what is the expected returns from the market?
So there are, I know there are a lot of questions here that I can see, and I don't think we'll be able to get to each one of those questions today. Maybe some of them they can follow up with you, Vivek, and we can answer. And this question, there are other questions about number of names in the portfolio and the mutual fund versus PMS, just glancing through it seems, and numerous ones, and the others about emerging market fund, the way and all that you explained already, but there's some other questions. So maybe those questions can come to you at a later point and maybe you can address. But on this question, because these are questions we've, addressed large number of times, and for a lot of our audience who are regular audience and join every time, it may be very repetitive. So maybe if there are other questions which are more first time, maybe we address them more so. But on this specific question, what are return expectations? Return expectations in any market, what is logical return expectation over a longer period of time? The same should be the return expectation over a short period of time. It may materialize, may not materialize over long term or short term, but those are the logical expectations. So for India and for globally in any market, a reasonable expectation of return is in line with nominal GDP of that country in local currency terms plus the dividend yield. So that's the graph that I'm glad Dipojal you has brought up. So you'll see, and this is true in US as well, over a very long time period, the returns are in line with nominal GDP plus dividend yield. So in India, Nominal GDP growth rate over the last 30 years has been 12%, 12.4. Sensex EPS growth has been 12.2, and rupee return has been 12%. I mean, very close to each other. I mean, it should, theoretically, it should have been 13% because, or 13.25% or something, because you add the dividend yield. But obviously, multiple compression might have taken place because in FY 93, we were just coming off of Harshad Mehta scam where multiples were very, very high. So that might have knocked off 0.5%, 1 percentage point. But on an ex ante basis going forward, if you assume Indian economy in nominal terms can grow 10% or so, roughly half in 4 to 5% inflation, call it 5 to 6% real GDP growth rate. 5 sounds low, but I'm talking about over the next 10, 20 years, then a 10 odd percent nominal GDP growth rate seems reasonable expectation, and 1% dividend yield. So 11%, 10 to 12%, call it, expectation of return from the market seem reasonable going forward. A tad lower than historical past because the GDP deflator is likely to be a tad lower than historically.
Sure, Prashant.
Obviously, active managers
Sorry.
like ourselves, hope to and expect to do better than that as we have historically done.
Prashant, this is just another question on China, and I'll ask this: with China opening up again, does India's projection to be the leading manufacturing hub in the world still continue?
Yes, so obviously, if the China, so there's a lot of talk of late amongst investors and investors and corporates about the China plus one opportunity. So there is a structural element to that has been ongoing since even pre-COVID, because of combination of reasons. Because I mean, when Trump got elected, even before that, there was this ongoing desire for diversification of supply chain in Fortune 1000 companies around the world or any corporate around the world. Nobody wants entire dependency on China. But if you look at COVID and the supply chain disruptions that were caused by COVID, those were board level decisions that, look, we can no longer afford going forward to be completely dependent on one country in our supply chain. Yeah, most boards would. So just because COVID reopening has happened doesn't mean that these boards would say, okay, it's okay, it is a thing of the past and we no longer need to worry about supply chain. The COVID event has drove home the importance of supply chain diversification. The Russia-Ukraine event has drove home the importance of supply chain diversification. If someone was, and there are European companies who were dependent on Russia for a lot of their supply of variety of inputs, with the sanctions and all on Russia, their business model came under extreme strain. So with geopolitical tensions between China and Taiwan, remember, all these companies around the world, they have to do business continuity planning, in which they plan for things like terrorist attack, earthquake, hurricanes, whatnot, in place of doing business. So all 1% or low probability also they have to plan for. And similarly, with the geopolitical issues and the COVID pandemic issues and the Trump issue over the last 4, 5, 6 years, what has been driven home is the need for supply chain diversification. Yes, COVID zero, behind us, maybe that has on the margin reduced the sense of urgency. But directionally, we expect that to continue. India will be one of the beneficiaries unless India screws it up ourselves. We already doing business in India is much better. I mean, ease of doing business is much improved over the last 10 years, but still India is 63rd, right? So there's 62 other countries where it's easier to do business than in India. And a lot of the business coming out of China would go to a lot of those countries from the 62 countries. But India needs to continue to make it easy for people to do business. If we make it, for whatever reason, go back and make it more difficult, then that would be a bigger risk to the China plus one story than what's any COVID reopening or shutdown.
Sure, Prashant.
With the production-linked initiatives and other initiatives from the government, I'm not saying that's what's happening right now, but I'm just saying that is a risk to watch out for. But otherwise, I think the benefits to the manufacturing sector can last for a fairly long time of the China plus one.
Sure, Prashant, thanks. Maybe one question for Parag, from linked to the budget and the impact on the insurance companies with what was spoken at the budget, Parag.
Yeah, so see, especially for life insurance, in India, insurance is all about one is the saving component, and second is the protection component. And over a period, if you look at always the saving dominated the life insurance portion, and there has been changes there that if you shift to a new tax regime now, then the tax benefit on the life insurance premium which you used to get may not be available. So that's one change. And second change is, of course, the for more than 5 lakh rupees ticket size, there will be so receipt, or you can say the maturity amount of insurance would be taxable. So when you look at those two changes, of course, the saving portion of the business will get a hit for all the life insurance company. The impact would be anywhere between 5 to 12, 15% on the revenue or a APE, as you call, for life insurance companies. The profitability impact would be little lower because many of such policies are one time in nature or a single premium where the margins are generally lower than the overall company margins. But net, as I also said previously, there will be a reset of a saving business component of a life insurance companies. It would be more streamlined. I think the companies which will do after the reset very well would, somebody who has a very wide breadth across the channels, have multiple product lines. So all those companies will do very well over, let's say, next 3 to 5 years. But of course, for FY24, or you can say immediately next year, there will be some impact on life insurance companies.
I see a lot of questions on Hindenburg report as well. I think we'll refrain from going in too much details of that. But as far as the market is concerned, we think at a broader level, the effect is largely behind us. Yes, there was very heightened concern amongst investors, global investors, foreign investors, within the 5 to 10 days following the report. But as of now, I think foreign investors have also understood it's a very limited impact, a narrow impact on a set of companies, and the kind of things that Hindenburg report says has no bearing on the broader market. So we think it is not expected to have any implications for the market going forward, the broader market going forward. Also, a lot of questions I see about return expectations long term, but also specifically over the short term, going up to the election and so on and so forth. So I talked about the longer term. Let me just add a little bit more color to address those questions. See, on the short term, it is impossible to say what's going to happen in the next one. It's like, if you ask me whether it would rain on July 25th in Bombay or July 26th in Bombay, it's a guess. Sitting today in Feb, you can take a look at long time history and give some probability of how much it would go up, or how much it would rain or not rain. If you ask over the month of July whether it would rain in Bombay, you can guarantee, pretty much bet your house, that it would rain in July. So similar is with returns. Over the long-term time period, you can not guarantee, but you can have a lot higher confidence that the returns from the market would be the nominal GDP growth plus dividend yield that I talked about. Over any 6 to 12 months, it is impossible to say what's going to happen, because in 6 to 12 months, the market return is more a function of P multiple going up or down, which is impossible to predict. But over a long period of time, the returns are a function of earnings growth or cash flow growth of the company, which is in turn a function of the nominal GDP growth of the country. So that is the mathematical reason why in the short term, it is not possible to predict returns. Whereas in the long term, like I said, from Harshad Mehta's scam till now, the multiple may have reduced by, say, 20-30%. But over a 33-year period or 30-year period, a 30% decline in PE multiple contributes just 1% hit to annualized return, ignoring the compounding effect. Yeah, because compounding effect would be even lower, less than 1%. But let's say 1% impact. The 12% return is driven by the earnings growth during this time. So over long term, earnings growth is more than 90% of the return that investors have seen. But in a particular year, like when the scam broke out, if multiple goes from 40 times to 20 times, that's a 50% hit to the market, to the return. And even if earnings were to grow 10%, instead of 100 to 50, you will be at 55, still 45% down, right? So in a year, P multiple could be anything, depending on variety of factors, and that would drive the short-term return. It is impossible to predict, not difficult. It is impossible to predict over the next 6 to 12 months what's going to happen. I mean, one can always weave a very articulate story to suggest that the market should go up or down, but that is all that it is, a story. There is no real value to such articulate rationales.
Sure, Prashant, thanks. I think quite a few questions were on that. I think there's another question between return expectation from the equity markets and gold in the next 5 years.
I saw that. Again, it's impossible to say. I would say over a long period of time. And Dipojal, if you can bring up that guaranteed returns versus, so this is something I've experienced in my personal life over the last 37 years since I've been involved in investing either for family or myself or professionally since 1985 in equity markets. Fixed deposit of SBI after tax has grown from, if 1 crore, there were many people crore-patis in 1985 as well, though I was a middle class boy back then. But my neighbors were all our landlords actually, they were all crore-patis. Some of them invested only in debt or fixed deposit. 1 crore after tax would have grown to only 9 crores today, which is massive destruction of purchasing power. Because inflation itself has gone from 1 crore to 14 crores. And that is true almost universally globally. By investing in risk-free debt to sleep well at night, sleeping well at night does not come free of cost. There's a massive cost because over time, it erodes your purchasing power. It erodes real value. One doesn't realize because in nominal terms, you feel like you're earning 6%, 7% or whatever. But after inflation, you're losing money. And that's been the case in most countries globally. So inflation, 1 crore would have become 14 crore. Gold, 1 crore has become 27 crores. Yes, gold has more than kept up with inflation. Yeah, but it's only 27. 1 crore would have been 27 crore. Sensex in an ETF or Sensex as an index, if you had invested in, then 1 crore has become 176 crores. That's really what the compounding machine market has been, and I believe going forward would be as well, relative to gold and relative to fixed income and whatnot. Over any 12 months, 3 months, 3 years, 5 years, it is not possible to say. Yes, but 5 years is long enough time that the odds are quite high that equity market would outperform the gold. But you cannot be sure. Like from Harshad Mehta peak in 92 to 2003 bottom. So Harshad Mehta peak in 92 was 4,000 plus Sensex. And 2003 bottom of Sensex was at 2,800. Many people would have said, what, this market is useless. In 11 years, I'm below what I had invested in 92. Yeah, I'm getting out of here. Gold has given such great return during this time. Yeah, that would have been a terrible time to exit the market. Next 5 years, from 2003 to 2008, markets went up 7-fold. From 2,800, Sensex went to 21,000, more than 7-fold increase. So equity markets, it is a tremendous compounding machine, but it is uncertain when it would give you big returns, when it would take away some returns and all. It is the only person who is worse off than SBI fixed deposit, in my view, in the market, is one who keeps going in and out of the market. Many of them end up doing far worse than SBI fixed deposit. I personally, as a policy, never try to time the market. the last 30, I have been fully invested at the peak of dot-com bubble in 2000, at the peak of the 2007 GFC crisis, but I've also been fully invested at the bottom. The worst ones were those who got out at bottom and then stepped back in 100% later. I mean, in COVID crisis, a lot of people got out in March, close to the bottom, and then kept complaining about the dichotomy in the market as markets kept rallying despite dead bodies all around the world. Yeah. So all these uncertainties and all that this question is asking about, that has always been there. Market, global macro, you tell me when over the last at least 15, 16 years, the global macro environment has been certain. It's always been uncertain since Lehman Brothers crisis. It is fashionable to find uncertainty in the world. And there are more than enough highly paid economists and strategies who will find uncertainty in the world at all times, particularly, as I said, fashionable since 2008 Lehman crisis. So I don't believe that today is particularly more uncertain time than in the past, when you've seen stuff like COVID and Lehman crisis and other, I mean, in India, political uncertainty, right? Political in the sense, you don't know who's going to be elected and whatnot. That uncertainty is quite low right now, right? So the nature of uncertainty varies. Sometimes it's the pandemic. Sometimes it's Trump doing things that he did. Sometimes it's inflation. Sometimes it's war somewhere in the world, but it's always uncertain. But it always feels like right now is more uncertain than any other time. And I can guarantee you 3 years later, you'll all feel right now is 2025 and we are in 2026, you'll feel 2026 is more uncertain than any other time. But reality is it's always almost as uncertain. Yes, times like COVID, times like GFC, the uncertainty shoots up for a while, and that is reflected in the VIX index. If I see the VIX index now, it is not any to any degree extraordinary level of uncertainty. So if you look at the VIX index, right now it is at 18.51 CBOE VIX index. In COVID times, it has shot up to nearly 100. Yeah. So I don't think this is one of the most uncertain times. There have been far more uncertain times than right now. And even if it is one of the most uncertain times, there's no answer to what you should do. Because COVID bottom of the market, which is when the VIX index shot up to actually 65, is what this is showing here. Sorry, 83. I correct myself. At that point, you would have said uncertainty is so high, let me switch to gold. And that would have been the worst time to switch to gold from equity markets. Gold's been probably flat since then, or flattish, whereas equity markets have done extremely well since then. So, I mean, we've had sessions before this and we've talked a lot about it. The lessons from COVID, if we were to go to that slide for a second, a lot of the questions are pertaining to macro and all. So what were the lessons from 2020? We are nearly a 3-year anniversary, right? February 20 or so is when it started. So might not be a bad idea and if you're running out of time, maybe we can stop with a refresher on what were the lessons from COVID. The biggest, I mean, in one line, and we wrote a newsletter on this, and I'll request anyone who's not read that newsletter to take 10 minutes to read that newsletter. That is, to me, the most important lesson that of a lifetime that I learned, fortunately, very early on in the 80s, which is the futility of predicting investment returns based on macroeconomic worries and events. I just would read it again. The futility of predicting investment returns based on macroeconomic worries and events. And we've then split it into 3 lessons. The usual perennial worries of well-known, unknown variety, like inflation, interest rates, economic growth, and all are a colossal waste of time. Because all of those were disastrous in the year 2020, and yet markets provided supreme returns, one of the best returns. Lesson 2, nobody has a crystal ball to forecast unknown risks like Russia, Ukraine, pandemic, and all that. But even if you were bestowed with perfect prior knowledge of what's going to happen in the real world with the pandemic, market implication remained completely unpredictable. If you knew in February 2020, these many people would die around the world, these many lockdowns, these many infections and whatnot, and the COVID zero and all that, would have sold out and gone into gold at that time. So in a way, people were saved by not having the perfect knowledge of what's going to happen in the world. And then finally, lesson which summarizes all this is investment decisions that are, instead of bottom-up analysis driven by macro considerations, are fraught with very high risk of substantial, absolute and relative losses, which we've seen in every crisis, people bailing out because of the media headlines that all look very dangerous in such time periods, and then getting in much later. So I'll just pause there and see, Vivek, it's been close to 1 hour 25 minutes. Do you want to continue, or?
Yeah, maybe one final question, Prashant, which is there, and that's on the debate of active versus passive, and if active managers can continue to generate alpha in India, and then we can close session, Prashant.
Certainly. So I have had the somewhat unique amongst India managers opportunity to have managed US funds as well for investors when I was living in US for 11 years, and developed market funds as well, and EM funds as well and all. So see, US is the ultimate in market efficiency. It is still possible to generate alpha in US, but if you can generate 1 or 2% alpha, as we were talking in case of Warren Buffett, if you can generate 1 or 2% alpha, you'll be in top decile, top quintile over time. Yeah. In India, fortunately, the markets are not so efficient. They would gradually become more and more efficient as more and more people invest, and there are more and more fund management houses and PMSs and all. They would become more and more efficient over time. But this is an evolutionary phenomena, not revolutionary or sudden step function phenomena. So maybe over the last, like if you look at, my own, and this is all public on Bloomberg and all the data is available, 10 years at Goldman generated somewhere on a gross of fee basis, more than 800 basis points, somewhere like 850 basis points or something of alpha. That was the time period between 2007 to 2017. Now it is possible that the following 10 years or next 10 years, the alpha opportunity inefficiency in the market is reduced. But has it gone to low single digit or zero? I don't think so. I think the opportunity still exists of mid to high single digit alpha generation. It doesn't come in straight line, but you'll see over the last 6 years, over the last 5.5 years, we have generated 5.5 to 6% gross alpha, as the chart, if I remember correctly, is showing. And that puts us amongst the top. So it is maybe the top decile level of alpha, maybe in India, 3 to 4%. If you are able to generate, or 4 to 5%, you would be in top decile in India. That number is maybe 1 to 2% in the US. Because of greater inefficiency in India, you can generate more, and every percentage point over time obviously adds up to very large figures. So I often joke and say, when I'm asked this question by investors globally, that passive investing is possibly a career risk for my great grandkids generation, not for our generation. At least as of now, that's my belief, because this is a very gradual evolutionary process. US has had institutional money management at scale for last 100 years nearly. India has started just in the 90s. It's 25 to 30 years old only. So thank you all for taking the time. Much appreciate. I know it's fairly late in the evening in India as well on Thursday. You all enjoy your evening, and happy investing. Thank you all on behalf of WhiteOak.
Thank you.